All right, welcome. You're with us here in conversation with Ajay Srivastava, and we always look forward to touching base with him regularly as well as during festive. Ajay, it's all about glittering gold this festive season.
I tell you, this is Diwali. We have to salute our grandmothers and mothers who gave the best advice against all the MBAs and analysts in the world. I think this Diwali is dedicated to the grandmothers and the mothers who told us do nothing but buy gold first before you touch anything else, or buy silver. Everybody's got it. So the great grandmoms, great moms, wherever you are, and some are alive, some are not so alive, but I think we must thank them for bringing us to where we are, and all are feeling so festive. Even the equity market doesn't make you feel so, but net worth wise, everybody's feeling good.
So, in terms of gold, there also being some amount of FOMO buying. Do you agree with that kind of view, Ajay? We were in conversation with some other experts, and one view was that this is just FOMO-led buying, and gold historically hasn't delivered this kind of return.
You know, you can call it FOMO. Everybody who didn't buy gold can call it FOMO today, but I still believe that longer term, this is one asset class which is intrinsically part of your portfolio, and it doesn't matter what you buy. See, Aabha, I keep saying that today, if I start earning today, all right, what do I do? The price was 60,000 maybe 2 years back. Doesn't bother me, but I am starting my life today, and therefore I need to put gold in my portfolio today. So I am not a believer of this FOMO concept. FOMO is just a very emotional outburst of analysts who lost out to gold this year. So ignore it, buy it, keep it. Diwali is the time to buy it. And don't worry, 1 year it doesn't matter. Second year, third year, fourth year, this is going to give you fantastic returns, as if equity gave you return every year. So I think anybody who tells me about FOMO, I tell them, did equity give us any return this year? No. Therefore, buy gold if you can. If you have not started, you need to buy it. If you have it less in your portfolio, you need to add on it. And don't worry about the naysayers. They have been saying that for 20 years, and we've still done better than Warren Buffett.
Okay, fair enough. Where are you looking at within the equity basket, Ajay? Is it which sectors? Because we've seen a lot of rotation this year.
Well, I think nothing new has happened in this country, except the fact that the same domestic sectors continue to take the route. Anything which is international exposed doesn't give you returns, whether it is IT, which has not given any great returns. Pharma has given some returns, but has been muted off late at the end of the day. So I think your domestic sectors, which are focused upon select niche areas, and I think when I say select niche, is one is auto, and second is engineering, and engineering also does phenomenal exports. So I think these two segments have been a very good bulwark. We are strong in India, good companies, all deleveraged companies. So auto, engineering, and the third category we have always said is good for India is the hospitals and the healthcare, because that's just starting off. We can't even imagine where this has to go, the internal trajectory. So in terms of growth, pricing power, anybody who's been to the hospital knows what they used to charge 3 years back, what they charge today. So in terms of pricing power, demand, local demand, scarcity of supply, healthcare hospitals will do well and continue to do well. They can't do well every 6 months, but they do well over a period of 3 years. So auto, engineering, healthcare, and e-com. I think these are the four segments that we have divided our portfolio by and large in. There are a few odd stories which may be there, but four big segments where we have loaded ourselves. And let's not forget, thanks to gold, the gold loan companies. I think they will do, and they will do astoundingly well in the next 12 to 14 months. And it's a liberal RBI. So gold loan companies will do well, autos, engineering, Indian healthcare, I think, and e-com. I think you've got a fair amount of companies in the portfolios to work with.
Okay, so many opportunities there. You talked about auto and Hyundai in the news today with a slew of launches. I think four more this fiscal 22 for calendar 2026. What are you making of the kind of buzz that we're seeing around this comeback in auto ancillaries, just pre-festive season and going into the new year?
Festive season is important, but look at the long-term trajectory of this segment. The reason I say long-term trajectory is that we are the strongest in auto components and auto ancillaries around the world. I think even we are better than even China, most of it, because Indian companies have globalized quite well. They've bought companies in Europe, they copy America. So we're not just a domestic company and so on. And we are fairly competitive with China. So this is one segment of the market where India can compete and do well. And we have a large domestic market segment as well. So, and the car companies are not only making for India, as you see in Maruti's case, they've exported a lot of cars at the end of the day. In fact, the exports are growing faster than domestic market. So in a nutshell, therefore, this is a competitive strength that India carries in the sector, and therefore autos, whether it's end-use autos or ancillaries or products, I think will be a great segment in the next 5 to 7 years. And if rupee goes to where it has gone to 90 rupees, the realization will be phenomenally good for the export part of the ancillaries and companies. So I think it's all in all strongly positive because we are competitively strong without any government subsidy. That's more important. It's not like steel, where they need protection. Every morning they cry to the father and says, protect me from the village bully. But car companies, auto companies can compete on their own without government support. And that's why the sector is great for investors.
Great, that's a great outlook, Ajay. In terms of, you said nothing much has changed. We did see the GST fillip coming in. We are looking at the government at least trying to implement reforms that will lead to a larger consumption push. Do you see this as incremental or do you see a far larger impact?
I would have, been very happy saying it's a far larger impact, but then I see what's happened in Bihar. We are back to the area of doles being extended. Now, when you keep repeating this experiment across all the state will go for elections and national elections, at the end of the day, how much of this money is going towards new doles? If this money was coming to the consumers, and let me be honest to you, Aabha, the government can say they're giving us the money, they will find a way to take it back. Let me tell you, somewhere or the other will be taken back. So I'm sorry to say that. So impact will be there, but impact is limited because on the other side is the profligacy of giving out doles 10,000, 2,000 per person, 5,000 per person, which is like helicopter, old economic term, helicopter money. Now that doesn't augur well, and that you've seen the demand pattern that it's not panning out if you start donating all this kind of money to everybody at the end of the day. So yes, I'm positive. This will be a positive step, but I'm not too sure whether the economy as a whole as a thing which going towards and saying, okay, we're going to be progressive market economy and therefore people need to work to make a living at the end of the day. That's what needs to happen. But here we are giving away money to people to say, stay at home, we'll give you, ration, we'll give you electricity, we'll give you healthcare, we'll give you money in the bank. Why does he have to work then, my friend? And therefore, sadly, I feel that nothing much changes in India because we are back to where we were, trying to give doles and, at the end of the day, some benefits, but some losses as well in terms of where we were 10 years back.
Fair enough. Ajay, I'm just going to process that and come back. That's like a more tempered approach than the usual, bullish kind of commentary. But if you had to look back at the year gone by, what are the key highlights for you or the key assessment for you? I mean, you just shared one in terms of the fact that you feel the needle hasn't moved too much. And I know the returns on the index weren't that great. But if you had to kind of assess like where we're at when it comes to the progression in the capital markets particularly and what we could look forward to next year.
I think one segment which has done extremely well, surprised everybody, on the upside is the real estate sector. Look at the rates which have moved up. Phenomenal. Unexpectedly, you never thought the rates are going to go 2,000 to 20,000 and 20,000 to 60,000. All of us have gained who own real estate at the end of the day. But the fact is, that's one segment which just surprises to the upside, which nobody ever projected. And to be honest, that one. The other segment which started very well was the capital market segment, which is the stock exchanges, your depositories, and so on and so forth. It went into a slew of problem because every time it used to do well, the regulators say, you're doing too well, so let me cut your options, futures, trading, and let me change expiry date, etc. So we had a very well we started the year on capital markets teams, ended the year with rather shakily because at times the policy changes were affecting us. And I think next year, if policy changes are kept to the minimum, let the market do what's supposed to be doing. I can vote at 18, I can have a child at 21, but if I buy a future and option, I need to be nursed. Now, that's not a fair way to look at the market. Let the market do what's supposed to be doing. Yeah, stop the malpractices of anybody, manipulating the market, but let the capital market segment grow because that is the core on which India has grown in the last 12. So one is your capital market is the IPOs. It has surprises to everybody. And you will not, and I'm sure that people can argue about this, but the fact is, and IPOs at valuation which are nutcase valuations, absolutely nutcase, and everybody could IPO. A Mangal Sutra guy can do it, Aate ka Chakki can do an IPO in this country. It's a great thing because people don't need to borrow money and they can run the businesses. But at the end of the day, it surprised us with the ferocity of application and mutual fund. I think it's the two landmark things we have seen. So one, we saw very clearly the real estate prices. Second is the mutual fund, which has resulted in an IPO boom India has never seen.
They're talking about the capital markets. There's likely to be a grow IPO coming up. Would you look at some of these favorably? There's also Lenskart, LG, of course, just made history. Tata Capital, which was the biggest from the Tata pack in a while. Where would you look within that basket? Where do you feel it's still reasonably valued or reasonably a safe investment bet?
Wow, I want to hear the word reasonably valued sometime at least. I wish I could answer India, that, yeah, this is reasonably valued. Nothing is reasonably valued in this country. You need to buy a share, you need to suspend all what you learned about PE, EPS, CAP, everything, just forget it, because you're not going to get a reasonably valued share. Okay? But I think the way to approach it is what it is at the end of the day. You can't fight the market, it's what it is. But I think companies with reasonable moats, and I think I'm not recommending, but I'm saying something like Lenskart. It's a global company, size company. It's done something which no one has done, means start to finish, they do it, they make it, they sell it, and so on and so forth, and with sizable scale and now profitably. I think those are the companies I'd rather go to. I would not go for name, just not for example, but go for a Tata Capital, because there's nothing new in that company. You've got hundreds of companies, the HDB Services, Bajaj Finance, Muthoot Finance, Cholamandalam Finance. A financial company, there's nothing new to the market. There is no more Tata has in terms of what they do or they don't do. So if one were to allocate capital, we don't have unlimited, one would rather go for a company like Lenskart, which has got a moat of a significant kind, or compared to a Tata Capital. And I think that's the way to look at IPO, saying, yeah, they're expensive, but at least go to companies which have a strong moat and are solely the global scale kind of companies, which is why I said e-com companies some of them are really good. They may not make money, but they're globally scalable product and makers. And therefore, I would say choose wisely, because this will dictate your return over the next 3 to 5 years, is find companies with reasonable moats and a unique business model which can get them value. Run-of-the-mill, a steel mill, a Tata Capital kind of stock, capital is all okay. The 100 companies do NBFC in this country. What's new, 101st will do for me. But first guy who makes specs from lenses from start to finish I can't find that kind of company. I'd rather go invest there.
Fair enough. Ajay, today the consumer has a lot of different opportunities, in the sense that with gold glittering, the IPO market also creating this FOMO effect. We've got a lot of interest in global tech, of course, perhaps other opportunities as well globally. How would you suggest an investor shape up their strategy going ahead for the new Samvat?
The first is, you can't have 100% India. Unfortunately, I'm a proud Indian, I have Indian citizenship, but I can still say it's not advised to 100% India, because some of the companies which you can invest in the US, you can't get them in India. Quantum computing, you can't get in India. So marine technology, you can't get in India, right? So therefore, I would say, I've recommended to all my customers and when I meet people, is start allocating at least 33% of your portfolio to the US market, because that's what you're not going to get in India. Some 10 to 15% or 20% you go for your metal, which is gold, silver, whatever you feel comfortable with, or at the end of the day. That makes it 55, and 45 is what you earmark for Indian market. That's the way I would look at. In that 45, 10 to 15%, we got reasonably good REITs. There's a power transmission REIT, there is a mall REIT, etc. Good quality REITs giving 10% plus returns and capital appreciation. Allocate to that, and 35% you allocate to equity. And you can make it go up and down. But roughly speaking, that's the way I would divide my portfolio for a safe, sound sleep and a happy Diwali.
Fantastic advice, Ajay. Always a pleasure, and thank you.
Thank you very much.
Fun for us. Thank you. Wishing you a happy Diwali.
Same to you guys, everybody. Thank you. Bye-bye.
Hello and welcome to Business